No women? No women?
Anna tried, but there was no. Anna tried, but there was no people of color.
The chair wants to welcome this extraordinary panel before the committee, and we want to introduce you individually, and then we will ask that you all stand after the introduction so that we can swear you in. To my left, Mr. James Tierney. He's a lecturer in law at the Columbia Law School, and he's the former Attorney General of Maine. Welcome, Mr. Tierney. Next to Mr. Tierney is Mr. Christopher Peterson, a professor of law at the S.J. Quinney College of Law. Welcome, Mr. Peterson. Next to Mr. Peterson is Mr. Ira Reingold. He's the Executive Director of the National Association of Consumer Advocates. Mr. Reingold, welcome. And next to Mr. Reingold is Mr. Nathan Benson. He's the CEO of the Tidewater Finance Company, Incorporated, and he is testifying on behalf of the American Financial Services Association. Welcome, Mr. Benson. And now I'd like to swear the witnesses in. Will the witnesses please stand and raise your right hand? Do you solemnly swear to tell the truth, the whole truth, and nothing but the truth? Let the record reflect that the witnesses all answered in the affirmative. The chair recognizes Mr. Tierney for 5 minutes for the purposes of an opening statement. Please put the mic close to you.
Thank you, Mr. Chairman. My name is Jim Tierney. I'm the director of the National State Attorneys General Program at Columbia Law School. And in that capacity, I work closely with the men and women who serve as your attorneys general and your staffs, all of whom are deeply committed to rooting out fraud in the area of credit. Testimony is obviously my own, but I have discussed it with a number of attorneys general, including your own, Mr. Chairman, Lisa Madigan, and I think I broadly reflect the views of those attorneys general who are committed to this important issue. I think if there's one thing that is clear is that we have insufficient consumer protection in the field of credit. That's the bottom line. We're not doing enough. The crisis is real and it's growing. And if there's one single lesson that has to be received in the halls of Congress, in the halls of federal regulators, including the Federal Trade Commission, is that the states got it right and the states got it first. Speaking bluntly, until we have effective state regulation from state attorneys general and state banking commissioners, we will never get ourselves out of this hole. The question is, how do we get from here to there? And that is a challenge. And there's a long history of relationships between the federal and state approach to working with these issues. Federal government has a number of very narrow federal statutes enforced by not the Federal Trade Commission, but forced by banking regulatory agencies whose first job is to assure the safety and soundness of the banking community. And we see how well they've done that. But in addition to that, it is their responsibility, allegedly, to deal with consumer protection, and they just don't do it. It's not their highest priority. It never will. On the state side, you have broader laws, State Unfair, Deceptive, and Trade Practices Acts, which are flexible. And state attorneys general get it right and get it first, not because, although they show great leadership and great courage, they get it because they're structured to do it. They live in communities. Like you, they have constituents. They're able to move and move quickly, and they're able to move on a national basis and on a bipartisan basis so that they're able to achieve some very specific and concrete results. Now, get to the hearing of the Federal Trade Commission. There's a long history between the Federal Trade Commission and the state attorneys general. Sometimes it's very positive. In the 1970s, federal funding, with the help of the Federal Trade Commission, actually went to the states to get states more involved in consumer protection. Again, during the terms of the first President Bush and President Clinton, again, we had warm and solid relationships with the Federal Trade Commission, and the states were on the same side. The last 8 years have been very cold years. And I commend our new chairman. Our new chairman did the best he could to explain the facts as he found them. But the bottom line is that the Federal Trade Commission has been on the sidelines on a number of very, very important cases. And this is very unfortunate. Not only were they not involved in the cases, but even informally, they never called up an attorney general and said, what did you learn? What are you seeing about the patterns of fraud? And this is a serious problem. I commend the chairman for reinstituting the executive working group, which I called for in my formalized testimony. It's extraordinarily important. There are some regional directors of the FTC who work with the states. There are some who not. Certainly the FTC are bringing cases, but are these the biggest cases, or is the FTC showing an instinct for the capillary? Are they striking at the major issues, or are they grabbing onto low-hanging fruit when they go after a case? We don't know. We don't know because people are not sitting down in the same room and discussing how do we put together a systematic, sophisticated process by which we can root out consumer fraud. And that requires a lot of work because there will never be enough lawyers in the Federal Trade Commission, never, 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 to track down the kind of consumer fraud we are seeing. The FTC has to work with the states, state banking commissioners, the private bar, consumer advocacy groups, in other words, all the people that the states work with every day as they fashion the kind of priority prosecutions that are absolutely necessary to make this happen. Now, not only have the states brought the cases that have been alluded to in the earlier testimony, the Household, the AmeriQuest, and the Countrywide, but they've had to do it with one hand tied behind their back because they're litigating with the same federal agencies who are trying to preempt them from bringing these cases at all. That case is back before the United States Supreme Court again in April. It's a serious issue. The Banking Committee has held hearings on this. It's extraordinarily important that the Federal Trade Commission and the chair of the Federal Trade Commission stand up, as has the chair of the FDIC, Sheila Bair, and said this is not a time to preempt states. We have a problem. We need more consumer protection, not less. And the timing is of extreme importance. So with that, Mr. Chairman, thank you for giving me this opportunity, and I look forward to answering any questions that you might have.
Thank you. The chair now recognizes Mr. Christopher Peterson. Mr. Peterson, you're recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member. It's an honor to be here today and share a few thoughts. I'd like to start with 2 quick statistics, if I could, about the subprime and alternative mortgage product crisis. The first is 6 million, roughly 6 million foreclosures coming through the pipe, according to Credit Suisse. And then in foreclosure rescue scam cases brought by the Federal Trade Commission, 6. According to their testimony in the Senate last month, they brought 6 foreclosure rescue scam cases for 6 million foreclosures. That's 1 in a million. Where I come from, that's the sort of cliche that you talk about when you say that you're not doing anything, right? In my view, honorably, the Federal Trade Commission is a good agency that does their best, but they're not doing anything. We're talking about taking teacups of water out of an ocean. It's just not even close to the sort of magnitude of problems that we're talking about. And so if I could just quickly talk about the rules, the law. I mean, we've all been talking about all these generalizations about, well, separating good loans from bad loans. Just talk about the laws for a second. There's the Equal Credit. They have 4 titles of the Consumer Credit Protection Act, and then they have their Deceptive Trade Practices Authority. The Equal Credit Opportunity Act is designed to prevent discrimination in awarding credit. It doesn't do anything in the way of preventing bad loans from being made. The Fair Credit Reporting Act, it tries to clear up inaccurate credit information, but that's not the problem that we had here. Lots of people had prime credit histories. We're still getting non-amortizing loans that have gone in waves into foreclosure. The Fair Debt Collection Practices Act is a nice gesture, but it generally doesn't apply to home mortgage loan servicers, and it comes too late. I mean, at the point where the loan's already in default and there's debt collection problems, it's too late at that point. And then the Truth in Lending Act is a nice idea, but it's too late. The disclosures are confusing. People generally just don't read them. They ignore the disclosures. And even if that was a great strategy, The statute that's designed to promote honesty in origination of loans doesn't apply to mortgage brokers, who are the people that actually talk to consumers. What sort of a truth in lending idea doesn't apply to the people who talk to the borrower? And then in addition to those 4 statutes, they also have 2 significant regulations that they've done under their Deceptive Trade Practices Authority. The Holder in Due Course Notice Rule, which doesn't apply to home mortgages, right? And that was back in 1975, and it's never been updated. And second, the Credit Practices Rule, which bans about 5 different, problematic contractual provisions, including confessions of judgment and pyramiding late fees. But it hasn't been updated since 1984. And this statute is, this regulation doesn't talk about any of the non-amortizing products and subprime products that we are talking about in the past few months. And that's it. I just did it. In 3 minutes, I summed up their entire regulatory structure. And it really doesn't do much of anything to try and prevent home mortgage fraud. And what are the barriers that prevent more stuff from taking place? Well, it's true that they have this inefficient regulatory rulemaking process, and it seems to me it would be helpful to get to speed that up. But the real problem is the fragmented federal regulatory system. I mean, on my hand, I can count 11 different agencies that are supposed to be dealing with this problem. The Federal Reserve Board of Governors, the Office of the Comptroller, the Office of Thrift Supervision, FDIC, the National Credit Union Administration, the new Federal Housing Finance Administration, am I getting that right? The new AFAO. HUD, SEC, the FBI and Justice at the same time, and then finally the Federal Trade Commission. In this fragmented system, the capital flows to the weakest regulator like water going down into the basement. And the result is that there's very, very little actual rulemaking to try and deal with the problematic practices that are actually in our industry. So I've been coming up with a list of all the things that I think need to get done, and I have this gigantic list of problems in our statute, in our statutory system. It's a big list. We're talking a lot of changes that need to be made. Congress could do that, but it's going to be a long and complicated bill. It's going to be very controversial. You could give it to a federal agency to try and do it, but which one would you choose? The only plausible existing candidates are the Federal Reserve, which already had that authority under the Homeownership and Equity Protection Act, or the Federal Trade Commission, which is a good choice but has nowhere near the resources and has a too expansive mission. In my view, respectfully, it's time for a new regulatory agency that deals exclusively with this issue and has authority to pursue protection of consumers on consumer finance issues. And if you're not talking about that, if you're just talking about more tinkering, then you're just kind of kidding yourself, and you're not really going to fix anything.
The chair thanks the gentleman. The chair now recognizes Mr. Reingold for 5 minutes.
Thank you, Chairman, and thank you, Ranking Member Downovich. It really is quite an honor to testify before you, Congressman Rush. I started my career as a consumer advocate in Chicago, where I began a Legal Assistance Foundation's foreclosure prevention project, and I worked through the mid-'90s dealing with all the mortgage crises that we had in Austin and Roseland, all over Chicago. And the things that we saw in Chicago in the 90s, we're seeing nationwide today. What I think disappoints me most about today's hearing is I'm going to go through the litany of things that we consumer advocates saw in the 90s, saw in the early 2000s, and we see the exact same thing today. Nothing has changed, in fact, except that things have gotten worse, and there has not been a federal response to it, including the FTC. I think about the world I see. I run an organization called the National Association of Consumer Advocates. We're the private attorneys, the legal service attorneys across this country who actually do the consumer advocacy work, who are on the ground every single day representing consumers who are losing their houses or having their car repossessed or being harassed by debt collectors. We see what's going on there, but the federal regulatory agencies and the FTC have not talked with us. So what do we have out here? Oh, I should mention, I also run a project called the Institute for Foreclosure Legal Assistance. So I'm in contact and talk daily with all the private attorneys, the legal services attorneys in the community who are actually fighting foreclosures. We are on the ground, we know who the bad actors are, we see the bad practices, and we see what's going on out there. So what do we have? We have a completely broken mortgage lending industry. There's no question about it. Unfairness runs rampant. Bad lending practices are everywhere. We have a broken mortgage servicing system. Completely broken. It's unaccountable. They can't figure out how much money people owe. They can't modify a loan to save their lives. We've seen Chicago is a perfect place, example of a dual credit market. If you're middle income or rich, you have banks. If you're poor or you're low income, what do you have? You have currency exchanges, and you have payday lenders, and you have rent to own, and you have refund anticipation loans. It is stealing wealth out of the communities that we care about most, and it's gone on unabated for the last decade with nobody really taking any real action there, and it's only getting worse. We have a debt collection industry that's completely out of control. We have the growth of a debt buying industry that's sort of mind-boggling in the way they go about collecting debts without actually even knowing, not having a contract that the person actually engaged, had that debt originally from, don't even have any proof that that debt is owed, yet they're using our nation's court and using our nation's private arbitration system to collect debts against people. We have a broken credit reporting system where consumers can't get real access to their credit reports. They don't get the information necessary, and they can't fix those reports once they're broken. All of those things are what our credit market looks like today. And when I went and talked to the consumer advocates who I talk to every single day in this country, and I asked them about the FTC and their role over the last 8 years and the last 10 years in protecting consumers, I'll just pick some of the adjectives that I got responded. Passive, antagonistic, irrelevant, disengaged, counterproductive, stuck in a world that doesn't regulate. They have not been part of the ball game here. They can cite statistics, they can talk about some cases that they brought. In the scheme of things, it's mostly irrelevant. Now, to be fair to them, they are under-resourced, and there are good career attorneys there who do their best, but the fact is they have been disengaged. I've been in Washington now 7 years after I left Chicago, and someday I hope to return. And I can't, on one hand, I can count the conversations I've had with the FTC, yet we're the people out there doing this kind of work. We are out there on the street. It really is sort of mind-boggling to me that we sit here today with the problems that existed 10 years ago, and we've had federal regulatory agencies who have done nothing except exacerbated the problem. The Federal Trade Commission, as Chris said, was using a spoon to clean out an ocean. They simply did not do the job. There's a number of things that can be done to improve them. Hopefully in a new administration, they'll be more assertive and more aggressive. They have been completely passive in using their unfairness authority. They need to use it. They need to declare things are unfair. We know when things are unfair. When you give somebody a loan that they can't afford to pay back, that's unfair. It's not a really hard thing to figure out. They do need greater rulemaking authority. It's crazy. 6 to 8 years to make a rule to protect consumers, that's just not the way it should work. Hopefully they'll have leadership, and I hope Chairman Leibowitz will demonstrate some leadership in terms of being assertive and aggressive in this area. They should have concurrent authority over the banks. There's a special place in regulatory hell for the federal bank regulators over the last 8 years, and they're a complete failure to what's happened here. So hopefully the FTC can use some of their consumer protection powers. I'll stop there, but be happy to answer any questions you might have about the FTC and the credit crisis we're facing.
Thank you. The chair now recognizes Mr. Benson for 5 minutes.
Good morning, Chairman Rush, Ranking Member Radonovich, and members of the subcommittee. My name is Nathan Benson, and I'm the CEO of Tidewater Finance Company, which I established in 1992 to purchase and service retail installment contracts. The company is based in Virginia Beach, Virginia, and has 2 lines of business. Tidewater Credit Services for consumer goods and Tidewater Motor Credit for auto services. I'm here today in my capacity as a board director of American Financial Services Association, AFSA, whose 350 members include consumer and commercial finance companies, auto finance companies, card issuers, mortgage lenders, industrial banks, and other firms that lend to consumers and small businesses. AFSA appreciates the opportunity to provide testimony to the members of the subcommittee. Today, I'll focus my testimony on the role that the Federal Trade Commission has played and continues to play in helping to restore confidence in the financial services industry. I will also address the installment loan industry's importance in providing access to credit to millions of Americans, the FTC as the effective regulator. The FTC has been very successful in enhancing consumer protection under its current authority. It has addressed the economic crisis in two ways. First, by using its enforcement authority under Section 5 of the FTC Act to pursue bad actors in the subprime mortgage industry. And second, by setting federal policy through guidance and public comment. I'll start providing some examples that fall into the first category. The FTC successfully negotiated a $40 million settlement with Select Portfolio Services in November 2003 for engaging in unfair and deceptive practices in servicing subprime mortgage loans. The settlement was modified in August 2007 to provide additional protection to borrowers, including mandatory monthly mortgage statements, a 5-year prohibition on marketing optional products such as home warranties, and refunds for foreclosure attorney's fees for the services that were not actually performed. The FTC has entered into a $65 million settlement with First Alliance Mortgage Company for making deceptive subprime mortgage loans. FTC distributed $65 million to nearly 20,000 affected borrowers. The FTC has successfully pursued other subprime mortgage lenders engaged in what the Commission deemed to be inappropriate conduct, including Capital City Mortgage Corporation and Quicken Loans. And now I want to just move on to the installment lending and its role in providing credit to consumers. At the outset, let me say that AFSA shares Congress' concern about predatory lending. We support the goal of protecting consumers from unfair, abusive, or deceptive lending and servicing practice while preserving access to responsible lenders. The installment lending industry was born in 1916 out of a need to provide credit to working men and women. The Russell Sage Foundation worked with the lenders to develop a set of principles by which they would abide in their lending activities. Lenders agreed to make the cost of their loans transparent so that borrowers understood the true cost of the loan. Loans would be structured over a period of time, allowing a repayment schedule that was long enough to match the earning power of the borrower. Finally, the lender would price the loan based on the character of the borrower, which was defined as a combination of borrower's employment stability and previous history of handling credit. Today's installment lenders are a key element in improving the socioeconomic status of poorer citizens and supporting our country's economy's health. They do this by adhering to a basic principle of economics, that people should borrow so they can consume based on the permanent income, and that such consumption is the fuel of our economy. Typically, the middle and upper class borrowers borrow through traditional banking and financial services relationships. However, average wage earners with few financial assets cannot borrow in this way. Traditional banks simply are not equipped to offer products and services to these consumers in a manner that is profitable for the enterprise. As a result, these consumers need access to safe forms of small sum credit. These are the very products the installment loan industry, an industry fully and completely regulated and examined at the state level, have been providing successfully for decades. Certainly, people turn to installment lenders for multiple reasons. Key among these, however, is the need to access small sums to deal with unforeseen circumstances. I can go on many, but if there are any questions, I'm welcome to take them.